Chamath Palihapitiya is always great to listen to, as in his interviews he typically tries to burn down many of the sacred cows of Silicon Valley, particularly having been an outspoken dissident about the dangers of social media and the impact it has on children. Just yesterday, with Jason Calacanis on This Week in Startups, in episode 864, there's an excellent 45-minute interview, well worth watching the full thing. He discusses the changes in the last year on dropping his LPs to refocus on investing in companies that matter. And specifically today I wanted to address, he also comments on the Ponzi scheme of Silicon Valley. I recommend the whole 45-minute interview, but if you want the 3-minute summary, here it is. In Silicon Valley, there is the potential now that funds can actually become more successful simply by the fees they manage than looking for profitable exits. When an investor courts a startup, they receive two things in return: both a yearly fee for investing other people's money and an upside of profits if the startup is successful. But as he suggests, if you have a fund of $500 million in management at 2% yearly fee, you now are bringing in $10 million in profit, which can be divided among the 4 to 5 partners in that fund, meaning each is taking home about $1 to $2 million a year, or could be making $10 to $20 million over the course of the decade. And the way that they're able to do this, and the reason that people continue to invest in their funds, even if companies may not be having exits, is that there's the illusion of success by looking at the metric of growth. And growth is where we get the Ponzi scheme aspect of this come in. A company will raise a Series A fund from, we'll call Fund A. And when Fund A comes into the board meeting, they ask that the company grows quicker. And so much of that fund money goes into supporting Facebook, Google, and Amazon. In fact, Chamath estimates that 40 cents of every venture dollar goes into those big three. The company now looks like it's growing exponentially, but this is really non-profitable growth. And the rise in the company's growth isn't because they're making better products or that there's tremendous product market fit, but as I say, because of this superficial, financially driven growth. Eventually, the company will start to get short on cash and they'll look to raise a Series B. And in the Series B, the group from Series A tells everyone, well, look at how amazing the growth is here. You want to invest. And so the Series B is raised, and then the same process repeats and it goes to a Series C. And along the way, what happens is that the Series A initial fund actually looks pretty good. The IRR on Fund A is huge, and the managers feel that they're probably pretty good at identifying good businesses, and so they end up starting a second fund. And this process repeats. And the endless supply of money keeps coming into the market as new investors who have even no experience in this type of area continue to put their market into new funds. New funds are started, and the Ponzi scheme of cash, investing in companies, which fuels artificial growth, which fuels subsequent investment rounds, continues on and on. And in the end, the only people which are really walking away successful are the fund managers making 2% per year on managing the fund. And in the end, those who have invested their money into the fund may not receive it back. And those who are the actual company owners are being forced in some ways to focus on metrics such as exponential growth, which may not be part of a sustainable business model. Chamath prefers to look at the best companies out there right now, such as Amazon, and Bezos grew that at 25% year-on-year growth for 25 years. And now his slogan is really grow real and grow slow, which is essentially a complete slap in the face of the typical ideology on how to grow a company in Silicon Valley today. As far as future investments, Chamath is looking to get back into trying to find companies which solve real-world problems, and if they succeed, will have a meaningful impact on the world. And they should get there by building a real business with real growth. What a radical idea to have, finally, that people should be building real businesses. Well, we'll see if we get back to that.